Are you interested in learning more about the nuts and bolts of reverse mortgages? In other words, how much money you get from it, how much money you keep, and that type of thing? I'm Dan Kapellen with Pacific Lending Group. We are partnered with AAG, the American Advisors Group, the company that you see Tom Selleck talking about on TV. And a client asked me to explain some of the details. If you're looking for a general overview, I have other videos on that. Contact me if you are interested, but this is going to assume that you know for the most part what a reverse mortgage is and you're looking for nuts and bolts. The goal of a reverse mortgage and why it was created is to allow the elderly to age in place. These are people who have worked their entire lives for savings, and their house is really an asset. It is like a savings account that they're not fully taking advantage of. Now, what's the difference between a conventional mortgage, with which most people are familiar with, and a reverse mortgage? In a conventional mortgage, the borrower pays interest and some principal every month. Many elderly find that they have not saved enough or don't have enough income to afford the monthly mortgage payments. That's where a reverse mortgage comes in. Reverse mortgages are also known as HECMs, home equity conversion mortgage. And with a reverse mortgage, no monthly principal or interest payments are made. Instead, the interest gets paid when the house is sold. It accumulates every month and gets added to the principal, and it takes advantage of the equity that is in the asset of the borrower, which is the house. By not having to make these monthly mortgage payments, it reduces the monthly living expense. As a result, it can make aging in place a reality. Now, with both mortgages, whether it's conventional or reverse, property taxes must be paid, and the homeowner's insurance must be paid, and the homeowners association fees must be paid, and finally, the house must be maintained. It must be a primary residence. That's one of the requirements. So the maintenance is pretty much a foregone conclusion. Here's how a HECM, a reverse mortgage, can convert part of your house into cash. Let's say that you have no mortgage payment, such as the client who asked me to create this video. With a HECM loan, the cash can be, some portion of that house can be made available in cash to them. They can take it out at the time of closing, or they can convert it into a line of credit, which I will show in subsequent slides. Anything above that home amount is home equity that belongs to the borrower. The bank cannot get that home equity in the house, the difference between the home value and the loan amount. Here's a projection that shows the projected home price increase over time. This is a 10-year projection, and houses have over history increased at a value of about 4% per year. Below, in this case, a borrower would qualify for a loan of about $126,000, and the interest would get added to that principal every month, which means that the principal balance increases over time. There are three things that determine the principal amount that the borrower qualifies for at the time of closing. One is the house value, two is the age of the youngest borrower, and three is the interest rate, which is why you and I would need to talk in order to get the specifics for your particular situation. Again, there's no monthly mortgage payments being made during this time. Now, this particular client wants to take out $1,000 per month. They want to withdraw $1,000 per month from this line of credit. Today, interest rates are about 6.5%, and the line of credit pays 6.5%. So if there is no withdrawal from that original balance, the line of credit will continue to grow at 6.5%. And therefore, it is the same as what the principal and interest amount would be over time. Now, if the borrower takes out $1,000 per month, the calculation that I show suggests that their line of credit would run out just beyond 10 years. It would be at about 11 years. And so the concern is, well, what happens then? And the answer is that they still have this homeowner's equity up here. In other words, this orange line represents what the principal plus interest would be at 10 years. The equity in their house would be roughly $200,000. And so they have $200,000 that they can get if they were to sell the house, and they can use that money then to continue living on by renting or moving into an assisted living facility, whatever they want to do with that $200,000, plus maintaining their Social Security, pension, or other income that they qualify for at that time. This shows, again, the same chart as before, except that amplifies that the line of credit would grow at the same as the principal and accumulated interest. Their line of credit growth with no withdrawal is the same as the accumulated principal plus interest if the line of credit was not withdrawn. Now, what happens if the home price drops precipitously like we had in 2008? Well, if they sell it after 10 years and the price dropped to $200,000 as an example, that would be a very drastic drop. The FHA insurance protects you, the borrower, from owing more than the home value. You do not owe any debt, or your heirs do not owe any debt when the house gets sold. If, for example, it was just sold after 4 years and the principal plus interest had not accumulated to exceed that $200,000 home value, you, the borrower, would be able to keep the difference if you decided that you wanted to sell at that point in time. Another question that comes up is, does the bank own the house in a reverse mortgage? And the answer is no. You are the homeowner. It's the same as a conventional mortgage. The house is titled in your name. You are the homeowner. The bank does not own the house. If you have any more questions or want to learn more about your specific situation, like I said, I did this for a specific client and I'm using numbers I projected for them. Yours could very well be different. Call me, email me. My website can be gotten to by going to pacificlending.net/Dan. Or you can also scan if you have a scanner on your phone that scans QR codes, as you can see on the right of this slide. I love answering questions because every question I answered helps me get to be better as an educator, as a mentor to anybody who is considering a reverse mortgage. This is Dan Kapellen with Pacific Lending Group. Thank you.